Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
It's a mixed looking screen for now. The Hang Seng is down almost 0.7%.
No, not until we get it resolved.
The FIs, well, they are net short as well on the index.
It's not possible for brands or retailers to move 5 billion out of India to other countries overnight.
Starting a little cautious, 30 points lower, 27 points lower. But like I said, it's not too bad, considering the market defended critical levels yesterday.
Growth, market share gain, customer acquisition is at this point of time highest priority.
Numbers are expected to be muted in this quarter on a year-on-year basis.
We have a very ambitious product development program.
So Nifty right now down around 170 points as we speak. We have the mid caps which are underperforming with a cut of around 1%.
So ICM is roughly for us some 1,800 crore business.
Going forward in the current year, we would like to have a decent growth over the entire year's premium.
The net profit has come in much above estimates at 19,160 crores.
We are on course for a 6th straight weekly loss.
Well, that was the day so far. Hello and welcome to Closing Bell. Last hour of what's been a tough trading week. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Surbhi and Nigel. Guys, we haven't seen panic on any single day, but there has been this slow grind down in the markets. And once again, we're at the day's low. 24,400 is gone. I think the only silver lining is that yesterday's intraday low has not been breached.
That's exactly what I'm watching out for. 24,345. That was a low that we had hit yesterday. We're at 394, 395 as we speak. Let's see, next 1 hour, whether the bears pick up more momentum on the way down or if we pretty much amble around this zone. Very, very critical next 60 minutes.
Well, that's right. But it's a disappointing trading session, right? Because, any kind of shallow, any kind of bounce is being sold into. So those recoveries are very, very, meager, not able to take the selling. And the problem is the Nifty Bank, because on the way up, that one was dancing away to 57,500 odd. That's lost its way, and I think that's at a very crucial juncture. Yesterday, it bounced off this 55,000 odd mark. It seems to be in this range of around 55,000 to around 56,000. And for the time being, we're at the low point of the day. So that's a bit of a problem pocket for the markets.
Absolutely. I just want to pick out some stocks, actually, just to talk about what's been happening with the broader market. The Nifty is down about 0.8% right now. Mid-cap index is down almost 1.3%, and the advanced decline ratio is negative. So just let's pick up some stocks to give a sense of where the sell-off is happening. Now, it's definitely visible in defense stocks for sure. Even names like Mazgaon Dock, Data Patterns, you can still argue that it was bad earnings or weak earnings, and that's why the stock's down. But that's one pocket of the market which is definitely seeing selling pressure. Stocks like Kalyan Jewellers, after a good performance, good commentary, 30% growth, yet the market is choosing to quickly book in any profits that happen. So 8% down over there. Coforge, Rima will mention, there are some company-specific issues with Coforge that seem to be triggering the fall, but it is a big fall, 5% on Coforge as well. And then more names, there's Radico, there's Schneider, so plenty on the downside. However, the good thing is that wherever the market seems convinced with either news flow or numbers, it's willing to pleasantly reward companies as well. Example would be a Global Health, Medanta, 5% up. Kalpataru Projects, rate gain. These are stocks that have done really well on earnings today. And then the recent listing, Lotus Developers, Sri Lotus Developers, it's running away. And KRBL, the rice exporter. So even in an environment which is very, very bleak, you still have some of these sparks which are managing to find lots of buyers today.
Okay, all right. Well, we've got a lot of stock-specific news to track for you over the next hour or so. So let's get to AU Small Finance Bank. They've received the in-principle nod from the RBI to become a universal bank. Move makes AU's first bank, the first to receive this nod. What are brokerages making of this, bull versus bear analysis coming up on the show? Biocon delivers a miss across parameters in the April to June quarter. The stock is languishing in trade. A fine print of those numbers coming up in just a bit. And in other earnings reactions, we have divergent reactions on the likes of Cummins India, Kalyan Jewellers. We'll get you an analysis on their performances in the past quarter. All of this and more lined up on the show. Well, just one note though, just keep an eye out on the bottom of your screen. You have PG Electro Plus, one of those big, value creators over the last few years. Surprise, surprise, they have gone in there and they've cut their growth guidance, revenue growth guidance on the electric business, and the consolidated sales guidance as well, they have cut. So that's clearly come as a shocker. And at 15%, it's actually hit the temporary circuit. So just keep that stock on your radar. That one's up for you. But I think we have the SBI, chairman, Mr. Sethi, who's addressing the Q1 results. So let's hop across.
Kumar Tiwari sir, Shri Vinay M. Tonse sir, Shri Rana Ashutosh Kumar Singh sir, and Shri Ram Mohan Rao Amra sir, along with our Deputy Managing Director Finance, Srimati Saloni Narayan. I also extend a very warm welcome to the other Deputy Managing Directors and senior officials of SBI who are present with us this afternoon. We sincerely appreciate your presence and look forward to sharing key insights about the bank's performance. Without further delay, I now invite our Chairman Sir, Shri C.S. Setty, to address the media and present a comprehensive overview of SBI's financial performance for Q1 financial year 26. Over to you, sir.
Good afternoon, ladies and gentlemen. Thank you for joining the press meet post announcement of Q1 FY26 results of the bank. The results for Q1 FY26 highlight robustness of financial numbers, continued excellence, consistency, and SBI's significant long-term strengths. I would like to start by thanking all our stakeholders, including our customers, shareholders, employees, and the broader ecosystem for their support and helping us in creating sustainable value for the economy. Let me now start with a brief description of the present global and domestic economic scenario and then discuss bank's performance. The global macroeconomic environment has remained fluid since June till now amidst geopolitical tensions and tariff policy uncertainties that have increased. Central banks in many advanced economies kept policy rates unchanged, except, of course, Bank of England, which has reduced the rates. The last mile of disinflation turned out to be stickier than expected, while also awaiting clarity on the trade tariff front and its implications for inflation. Domestic economic activity held up in June, with high-frequency indicators pointing to mixed signals of improving prospects of Kharif agricultural season and continuation of strong momentum in the services sector on one hand, and deceleration of tax collections, industrial activity, and vehicle sales on the other. RBI estimates GDP for FY26 a growth rate of 6.5% and inflation at around 3.1%. The MPC in its latest meetings, as you're all aware, has kept the repo rate unchanged at 5.5% and maintained a neutral stance. Coming to SBI, the results for Q1 FY26 demonstrate the bank's continued ability to operate profitably at scale due to our substantial core strengths. These advantages stem from our institutionalized framework, which is guided by continuous improvement in processes and a commitment to fairness for all stakeholders. The total deposits have grown by 11.66% year-on-year to 54.73 trillion rupees. Term deposits have grown by 14.23% year-on-year. Our current account deposits have grown by 30.69% year-on-year. I'm sorry. And CASA deposits have grown by 8.05% year-on-year, with a CASA ratio at, I'm sorry, at 39.36%. Importantly, the current account growth has continued to remain strong for the bank during the year despite competitive market environment. Our foreign offices deposits have grown 10.42% year-on-year. I'm glad to share that the credit growth continues to be good with segments like SME, agriculture and retail personal banking posting healthy double-digit growth at 19%, 12.67% and 12.56% year-on-year respectively. This corporate sector has grown by 5.7%. Our foreign offices advances have grown by 14.81% year-on-year. The domestic credit deposit ratio was at 68.88% at the end of Q1 FY26, indicating sufficient headroom to address future growth requirements of the economy. The bank continues to demonstrate industry-leading asset quality at this scale. The slippage ratio for Q1 FY26 was 0.75%, while the credit cost for Q1 FY26 stood at 0.47%. The net NPA ratio improved by 10 basis points year-on-year and stands at 0.47%. We have a well-provided NPA book with PCR at 74.49%. The asset quality of the bank has continued to remain strong over the last 5 years, which demonstrates the quality of our loan portfolio, the robustness and improvement in our underwriting processes, and improved collection efficiency. The bank remains well capitalized and our capital adequacy ratio has improved by 38 basis points sequentially and by 77 basis points year-on-year and stands at 14.63% against 14.25% as on 31st March 25. CET1 ratio has also improved by 85 basis points year-on-year to 11.10%, and both the ratios are well above regulatory requirements. Based on the current profitability and growth trajectory of a bank, we believe we have sufficient headroom to take care of requirements of business growth. Bank has raised, as you're all aware, equity capital of 25,000 crores during the current quarter, which will support additional loan growth of approximately 2.5 trillion rupees. I'm glad to share the progress we have made in the digital banking, which is an ongoing journey, and it continues to be an important customer acquisition engine for the bank across asset as well as liability products. The share of alternate channels in total transactions increased from 98.2% in Q1 FY25 to 98.6% in Q1 FY26. More than 9 crore customers have registered on YONO, with 66% of regular saving accounts opened through YONO in Q1 FY26. Our subsidiaries are consistently performing well and continue to create significant value for all the stakeholders. Most of our subsidiaries are leaders in their respective segments. We will continue to nurture these subsidiaries and maintain leadership position in the respective businesses. The bank continues to report ROA and ROE greater than 1% and 19% respectively at the end of Q1 FY26. We reported total assets worth 67.69 trillion, total advances at 42.55 trillion, and total deposits amounting to 54.73 trillion. SBI continues to be the leader in all the risk-adjusted profitable lending and liability pools in India. Consequently, SBI's ROA above 1% is derived from the scalable fundamentals of banking, that is, improved business growth, controlled operating expenses, and maintaining robust credit quality. The bank's ROE profile is currently higher than its credit growth, implying CET1 accrual in the future. From this strong position, our goal is to consistently achieve a ROA of over 1% and ROE over 15% through the business cycles. To conclude, I thank you all for your continuous support of the bank. We consider it as a privilege to be able to play a role in driving the progress and contribute towards the growth of our economy. We remain committed to rewarding your trust in us with superior sustainable returns over the long-term horizon. I wish everyone here the best of health and happiness. My team and I are now open for taking your questions.
Thank you, Chairman, sir. We'll now move on to the media question and answer. To ensure a smooth and orderly session, questions will be taken in a sequential manner and individuals will be called by name to ask their questions. We kindly request everyone to follow the format and limit themselves to 2 questions focused on the results. If time permits, you may raise your hand to indicate interest and we will accommodate additional questions. Thank you for your cooperation. We will begin with Hansini from Money Control.
Hi, thank you. So overall, in terms of growth, 11% is very satisfactory. But when we look at corporate side alone, there has been a pullback in growth in particular segments like infra, telecom, road, aviation, tourism, etc. What is your view right now on the corporate lending space, particularly with respect to these segments where I called out? Where are you pulling back because you're believing that there is stress accumulation happening, or avenues are not as attractive as you would want them to be?
So the three reasons why the corporate growth looks a little muted in our books. One is there is some shift towards market instruments. We have seen that the utilization of working capital limits, which was 62% in Q1 of FY25, has come down to 58% now.
Mm-hmm.
Which means that, and we also have seen that some of the large corporates accessing the CP market, basically to replace the working capital limits. And that is expected because there's good amount of liquidity, and in the CP, a diversified participation, what we have seen. Not necessarily that it's banks which are lending on the CP market. Essentially, the mutual funds are very active on the CP, and the rates are much more affordable than the bank lending, obviously. That shift has happened, but I think these shifts keep happening on that. And once the rates stabilize on the bank side, they will come back to utilization. The second thing what is happening is in terms of some of the project, like we have very robust visibility on both on the pipelines in terms of proposals which are under discussion, and also sanctions but yet to be disbursed. We have almost 7 lakh crore worth, both segments together, proposals in pipeline as well as sanction but not disbursed. But the disbursements are taking time, while the repayments are actively being done. And in a rate reduction cycle, we also have seen every time the rates get reduced, there is a refinancing which happens. So the pricing, chasing for pricing happens. Some of the reduction also has happened because of the prepayments. We had a significant prepayments. Either they have got access to the market through equity markets, or the pricing what they expected probably we were not able to match. So there has been some movement there. But I believe that we are still thinking that, hopeful that we will be coming back to the double-digit growth in the corporate advances.
Perfect. In continuation to the question on pricing, cost of deposits are at 5.2% in Q1. Do you think that cost of deposits have peaked? And yields are also coming down. It's in the lower side of 8.9% now. Whatever has to be passed through in terms of repo rate cuts, has SBI done all of that? You see further scope for transmission of repo, and where do you see cost, yield and NIM settling? So NIM is also just a little over 3 now.
Repo gets immediately passed on. Anyway, the sectional benchmark linked loans are all getting repriced immediately, maybe in a couple of days after the repo announcement. That transmission has happened. What takes time is the MCLR, recalibration, which is dependent on how overall marginal cost on the deposits will move up. And some of the fixed deposits will take some time to get repriced. So from that angle, MCLR will take some time. Repo is completely passed on. You see the cost of deposits slightly moving up because of a lot of people rushing to lock in on the fixed deposits, number one. Number two, the costs are slightly coming down over the last quarter, which is generally Q4 is a better quarter. But on the overall cost of deposit management, I think we have done fairly well on that. As far as your question in terms of NIM, I mentioned earlier also, the NIM trajectory will be a U-shaped trajectory. Q1, Q2, it will probably moderate. And as the deposit gets repriced, and also we have some benefit of the CRR cut, which will come from September onwards. So I think the terminal Q4 NIM probably would come back to what we have on the Q4 level, basically. Yeah,
It will
about
be
3%.
similar to Q4 of last year.
No,
Thank
Q4
you.
of this year.
This.
I mean, the last FI, last financial year.
Okay. Thank you.
Next is Siddhi from Bloomberg.
Hi sir, Siddhi here. First of all, I just wanted to ask you, in the global macro sense, we've seen the tariff news that has hit. You being the largest lender, I just wanted to get a sense of commentary from you. What is the kind of impact this is expected to have on the credit growth for SBI and for the sector as a whole? Once you answer this, I'll ask my second question.
The tariffs, of course, there are two areas which we have to look at the tariffs. I think we have had enough discussion across the media and policymakers. One is the impact on our books. That is a limited impact because most of these 4 or 5 sectors which are directly exposed to the exports to the US, which are predominantly exposure to the US markets, overall exposure from the banking system on these sectors is very limited, and SBI also do not have much exposure on these sectors. But the second factor what we have to take is the uncertainty in terms of how these tariffs are going to play out, how quickly this is going to be addressed. So that uncertainty is something what I believe that a lot of investment decisions may be delayed and people will postpone their spending. So this is the second order impact of the tariffs, so to say. So our assessment is that while the direct impact on the sectors, industries may be limited, the sooner this issue gets resolved, the better. And I'm sure the government is working on that. And I don't see. And another thing is that Indian exports are broad-based. I think we did mention earlier also that both in terms of basket of exports as well as the geographies which the exports go to is broad-based. To that extent, I think the impact will be limited. As I mentioned, the narrative is more, the uncertainty is more damaging. I think that needs to be addressed.
Okay, all right. We'll keep cutting back, as and when we get some further important statements from the SBI chairman. For the time being, let's welcome Deepan Mehta, Director Elixir Equities, onto the show. Hi, Deepan. Difficult market for the bulls. We're going sideways to down. That big pop is not really coming about. And I think till we hold below the 24,750, odds are that the bears will be in control. That said, SBI's numbers are more or less in line. What do you make of the numbers and commentary?
Good afternoon and thank you for having me on your show. I think great set of numbers from SBI. And now I think the divergence between private sector banks and public sector banks has come down significantly on the financial front, on the qualitative front, and even on the technology front. And I was quite impressed with the technology improvements done by SBI. Yet valuations are significantly lower than some of the private sector banks. So I think the investors will try and shift away from the private sector banks into the PSU banks. And this trend has been noticeable for the past several quarters or so. In my opinion, I think PSU banks are very attractively valued. And if they continue to deliver on the earnings front and keep the NPAs low as they have been doing, then certainly the Ps can get re-rated higher. So within the banking space, I think there could be one pocket of outperformance. And I think SBI is the type of company you can make as part of your core holding.
PG Electroplast, Deepan, I don't know if you caught the guidance, but the company has sharply lowered its guidance. I think last year, the previous guidance was 40% plus, and now they're talking about...
we'll get the number.
Just get that number up for you, but I think
what's 20%. The problem, Rima. The problem is the management has been very, very optimistic. Yeah. They went ahead, they raised money from the market via the QIP. And then you come out and you cut your guidance like this. That's why the street is so disappointed, and that's why there is this kind of selling, because that's been a big, big value creator. In the last 3 or 4 years, everyone talks about Dixon. In fact, this has created even more money. But now just take a look at the fall, because out of nowhere you've gone ahead and you've cut the guidance. So clearly the street is very, very disappointed. I think we'll get some of those numbers.
The 3-year stock CAGR,
Yeah.
CAGR, not return, is 100%. That's the kind of wealth it's created. Yeah. But numbers up until now were very strong.
Yeah.
So in FY25, revenue growth was 77%, FY24, 27%, prior to that, 94%, the year before that, 58%. So it was fast growing. It was just the projection that pace is going to continue is where the miss seems to be. But Dipan, raised money, promised more, doesn't look like they're able to deliver on those high growth estimates. Your thoughts on PG Electroplast, and is this going to be the precursor to what we might see from the rest of the EMS pack too?
Yeah, good afternoon. You should have also added very high PE multiple to it. Yeah. So this is a deadly combination that you have a very high PE multiple, so you're trading at expensive valuation. In a way, the stock is slightly overowned because of the QIP and the way the stock has been rallying. And then, although results are okay, stock market tends to discount the future, and that the future is going to be stagnant for whatever reason, then that correction is going to take place. But I don't think it's a signal for rest of the EMS players, because PG Electroplast was largely into air conditioners, and we know that weather has caused havoc with all the air conditioning companies and their customers, therefore could get impacted by that. But by and large, I think if you see Keynes, if you see some of the other EMS players, their results have come out to be pretty decent. And I think valuations also have come down because the earnings have gone up. So I don't think that's a reflection on the entire EMS space. But yes, I think it's a company-specific issue. And I think the management is being a bit too conservative, because end of the day, there are cycles, and there's perhaps a down cycle in the air conditioning side, which can certainly improve over the next 2-3 years or so.
Mm. Okay, all right. Just trying to confirm this, but besides raising money from the market, the PG Electroplast promoters as well, I think they had sold some stake. If I look at the shareholding from March to June, actually the shareholding came down from 49.3% to around 43.7%.
Was it the QIP dilution?
No, I think that QIP was earlier, right? So at that point of time, between September 2024 and December 2024, the dilution of the promoters holding came down from 53.4 to around 49.3%. And from there, in the past quarter, we have it come down by another 4-5% or thereabouts. So that's why I think, the street is very, very disappointed. You go in there, you raise some money, and then in fact, you guide for a particular number, and then you come. Actually, I found that, on 26th of May, the promoter entity went ahead and sold 5% via the block trade. Okay. And that's why I think the street is extremely disappointed on these numbers as well. So a confluence of factors, high PE multiple, you go ahead, you give a big guidance, you don't achieve it, you raise money from the market, and then in fact, you sold some stake ahead of very, very poor numbers. So street is not not pardoning the stock right now.
Dipan, we're running out of time, but just a quick word on Kalyan Jewellers. Prima facie, everything looked fine. Stock is down though, 8%.
Yeah, I'm trying to search what the main reason, but I think pretty decent numbers. So maybe some knee-jerk reaction or something which we don't know, which may have taken place in Kalyan Jewellers. Could be some concentrated selling as well, but nothing wrong with the numbers per se. There's no negative news flow as far as I'm aware.
Got that. Out of time today, the SBI presser, we were listening to it for a while. Thank you very much for joining in. Enjoy your weekend. Here's a quick reminder for all our viewers. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with a journalist, along with curated studio tours, e-learning sessions, masterclasses, curated lifestyle benefits.
Welcome back. Still looking at a cut of about 200 points on the index. For the week, the Nifty has actually not fallen much. I mean, it's just a 0.6% fall. The small cap index is down about 1%, mid cap index about 0.8%. So by themselves, the cuts are not bad. The issue is that they've come at the lower end of the trading range, and the market has constantly been drifting lower over the past about 6 odd weeks or so. And that's been a little painful for investors to watch. By the way, I just want to put up the FPI flows picture on the screen because that remains the single biggest concern for the market. As these tariff issues are dealt with and, whatever comes out of it, we'll have to wait and see. And that's the picture. In July, it was the first time that we started seeing outflows after the whole tariff issue, which started in April. July was the first month of outflows, almost 18,000 crores. So far in August, as of the latest numbers this afternoon, our outflow is about 12,400 crores. And for the year as a whole, of course, we are negative in a big way, over 1 lakh crore going out of the market in terms of FPI outflows. This is, of course, the cumulative data, net of all blocks, all action, total FPI inflow, outflow, and right now we are in outflow territory. So that remains a bit of a niggling worry for the market. Let's discuss that and more with Sanjay Parekh, founder and CIO, Soham Asset Managers. Sanjay, good to have you on. Let me actually start right there. So the hope lies with fund managers with you, in your peer set in the mutual fund industry, PMS managers, that you folks will keep drawing in the big money because these FPIs have been leaving. Do you think domestic liquidity will keep supporting the market, or is there a risk?
I think, fund managers will also, one is the flows that they get, and the second is where do they invest. So I think we are in an environment where there is global uncertainty. Q1 was weak. Q2 also looks weak. So we don't see a big upgrade cycle right now. Having said that, clearly all the balance sheets are in place. And, the rate cut benefit should show up from third quarter onwards. And rains have been good. I mean, monsoons have been good. So there is surely a possibility that third quarter onwards, things should get better as the busy season starts, So that is a hope, but clearly, valuations are rich. So our strategy is, be selective. There is value, but, you still need to have higher margin of safety. And there is some more downside possible in the markets. And maybe some more time correction, and then we're done. So we're not so bearish, but there could be some more bias on the downside.
Sanjay, you've always believed in growth at a reasonable price or valuation, but you said there is value still in the market. Can you tell us where you see value? What are the opportunities? Which stocks have you all bought at Soham?
Yeah, so, what we own, normally some of them we own for very long term. And so there we see value in, let's say, Adani Port. I think it's come to a reasonable value now. Or in the energy space, which we already own, is JSW Energy, where I think there could be some more risk. And these are all where results have been quite good. And there would be certainly some impact on the port volumes if the trade slows down. But in a tough environment, Adani Port has done quite well. JSW has been absolutely a top-class result. Part of it was because of the acquisitions they did, but so that also structurally, I think, looks good, and we like them. So there are pockets where, there is value. Earlier, we had bought Oswal Pump in the solar pump, which again has done well, and results have been good. So we look for those pockets of undervaluation and selectively invest. And that's our strategy.
All right. Hi, Sanjay. Good to see you in. What about the flows that you're getting? As good as ever, your clients are calling up and saying, Sanjay, take another check? Or is there some resistance? Tell us.
No, sir, actually, all the family offices and all, they have actually given us mandate. And some of them, of course, mandate, the volume could be very different. For mutual fund, it could be larger. But they've actually said that you tell us and we can draw down. So there is no panic. People understand that this year could be slow. They have a long-term thought process. And even our distributors have been very, very mature on this. So I think, at least the large family offices would want to increase their exposure. They're still underinvested into equities. And at least for larger cap funds like us, where luckily we've delivered well on alpha and 3-year basis, there is clear appetite for increasing their exposure. But then we always handle them saying that, this is how the scenario is, where earnings this year will be like 1130, next year it will be 1300. We think that India should be not getting more than 20 times. So if these earnings are not downgraded, which I think that it will not be downgraded from here, then we're talking of 26,000, which is a reasonable upside from here now. So that is where I think a little more time correction, a little more price correction, some clarity on global front on this tariff issue, and then we will surely bottom soon.
So, but the lows of the year have been done, you think? Or will we revisit 21,700?
Yeah, at least, I mean, you never say never, but at least I think the next 2-3%, and then we're done. And despite earnings being slow, only thing is, things at the global front. I mean, if you have 50% duty, it's certainly not a good environment. So hopefully we have some sanity on the global front. And I think then we will bottom out not only on the markets, but also on the economy. And I think the economic indicators should start looking better from third quarter.
One good thing is with Trump's tariffs, 25% became 50%. Now, anyway, it's, that's out of the window. Beyond that, you can raise it to 1,000%. Anyway, that, there's nothing going to happen on that front. It's unviable at 50% also. At least that Trump tantrum scare, at least that's out of the way. That said, I think metals is something, a couple of them you've liked out there. Vedanta, now is the time for them to deliver, right? But unfortunately, the globe is in a bit of a flux. Do you think the stock is currently an ad? Because you've been quite bullish on the prospects.
Yeah, we've been owning it. I mean, we've added at 318, we added at 440 also. And we have our patience. There's serious value in this. The EBITDA will be more like 45, 47. I mean, on a console basis, it will be more like 50,000 crores. But even if you take attributable to there, it will be 40, 42,000 crores. So it's like 4.5 times the EBITDA for a company which is going to expand in each of the verticals. And zinc and aluminum is fairly benign. I mean, the prices are not collapsed. So we think it's a very good play on aluminum, zinc, and silver. And they're deleveraging at a parent level. And also leverage is not going to go up. So I think it's a seriously deep value. You will see dividends coming in the last 15 months. We got 50 rupees dividend. This year again, we already got 7. We get another 25 rupees. So it's a good dividend play plus growth. And hence we like it and we're going to hold on.
Okay, deep value seen in Vedanta. Sanjay, great conversation. Thank you for joining in. Enjoy your weekend. Look forward to the next one. Now it's time to get a handle on what dealing rooms are doing, saying it's D Street Chatter. Nimesh joins in.
Hi, Rimano. Another choppy day of trade. We just given up most of the yesterday's gains, and it looks like yesterday was more of a short covering and a technical pullback rally which got sold into. But again, today the feedback is that the flows are quite muted from large institutions, so there is not much depth in the market, and that's the reason why even the mid-cap index is sharply down. But again, the volume seems to be on a lower side across the board, including the broader markets as well. So that's something to take a note of. The sector which is seeing a big cut is the defense sector. For second day running, there is selling, is what I understand in defense names. The defense index is down more than 2%. A lot of individual stocks are down 8-10% as well. So that's where the big crack has come. In fact, it started from a sharp fall in the European defense stocks yesterday, and it's playing out across I guess, across markets, and it's impacting Indian defense stocks as well. So that's something to track on from here on. But as I said, while markets have gave up most of the gains, today it lacks depth. And there is a lack of buying as well from large institutions in the cash market.
Okay, absolutely. It's just getting lackluster. It's almost sulking. Don't have the expiry impact at all helping today. Nimesh, what about stocks though? I mean, there are some little specks of green here and there. You tell us. Anything interesting?
So the first stock on my list is EPAC Durables. We saw a sharp recovery in that stock after a large block. Nearly 5% equity got changed hands in the afternoon trade. And after that, you've seen a bit of recovery. So I understand the PE investor was a seller in today's block. The PE owns 10%, so they've sold 5% in the block deal today. And in terms of buyers, some domestic mutual funds are the potential buyers. So the disclosures will be quite interesting in EPAC today. So that's the first name. The second stock is Bharat Dynamics. The entire defense pack is under pressure for the last 2 days, as I've been saying. But Bharat Dynamics stands out, has been under pressure of late. It's sharply off the day of the recent highs as well. And in Bharat Dynamics, there is a strong buzzer indication of a big supply coming in very soon. So the government owns 74% and could be a seller there. So that's the buzz there. The third name is PNB Housing. An odd outperformer in today's market, but remember the stock is still in the F&O band. So whatever happens is the delivery has to be in the cash market. For the last 2 days, I understand there is delivery getting marked, and one leading AIF is a buyer as well. For PNB Housing, the next big trigger would be the appointment of the new CEO, which can come in the next 2 weeks. So that's a trigger there. And the last one is Inox India. Again, in a weak market, that's been buzzing in trade, up marginally up today. But for Inox India, the buzz is that maybe the company is likely to bag a large order very soon. So that's a trigger in Inox India.
Okay, all right, got it, Nimesh. Thanks very much for that. See you in a bit on Editor's Roundtable. For the time being, this is what we're looking at. By the way, PG Electroplast is full 20% lower now after that guidance cut. So another big earnings blow coming in over there. But for the time being, let's go across to the F&O desk. Nigel has the latest in terms of what's happening in the derivatives market. Nigel?
Well, the screen is telling you, right, this market is a little bit jittery. And if you just take a look at, the kind of action that you're seeing, there is lack of buying that is playing out because any 30, 40 point bounces are getting sold into. So the structure in the market itself has got punctured, and that's why the Nifty is down 200 points. Important to note, though, the VIX, that's still not at elevated levels. So normally the markets, the way we have corrected, we've seen the VIX easy over the 15, 16 odd mark, but that's still cooled off. That's still holding at around 12 odd. So that's a multi-week low on that index. And that's giving some kind of hope that maybe, in fact, we see one spurt, the markets may pull back a little bit, couple of 100 points, and then we form a near-term bottom. As of now, that's not yet in sight. The other, string that the bulls will be, clinging on to is the PCR. Now, we have seen in the past the PCR dips below 0.7 and you see a relief rally. Now, it's come down to around 0.74. At the start of today, it was more than 1. So that's come down because the call writers, they are back in the game. The kind of writing we have seen on the call side is telling you that the bears believe, they have got this covered on the upside. Just take a look at the open interest build up. The 24,600 call, there's close to around 95 lakh shares getting added. And the premium has nearly halved since morning. So that's the kind of fall that you've seen. 24,500 call as well, more than 90 lakh shares getting added out here as well. And the premium has seen a sharp decline. So these writers, they are pocketing their 150, 200 rupees odd, and they believe that the 24,750 level will not be breached on the upside. What's giving some hope is now in the last hour or so, the 24,400 put. Just pull that one up. Yes, it comes up for you on the screen. The premium's around 120 rupees. In all probability, there is writing out here. So that 24,300 odd level, that's what those writers are hoping will hold out. So on the upside, the 24,750, that's the level that's going to be a resistance. But on the downside, yesterday's low, that will be the near-term support. You don't want to breach that mark. And on the whole, that band of around 24,350 to around 24,450, crucial, extremely crucial band is what we're looking at. Finally, RBL Bank, I've seen a big open interest build up on that one. And, that could probably go into the F&O band. So we'll have to keep an eye out in that one, a possible F&O ban entry. So because of the big open interest surge. Back to you, girls.
Thank you very much for that. We will slip into a very short break with the news that the Nifty is very close to yesterday's low, 24,357. Things are unraveling on the way down very swiftly. It's just like 10 minutes back, we were at 24,400 and we've lost about 50 points. So now very close to yesterday's low. Let's see what the last 15 minutes hold. For now, it's a break. On the other side, BTST calls with Nitesh. Welcome back. Mitesh is now back with us. The Nifty, by the way, breached yesterday's intraday low. 24,337 was the low now. From there, we're trying to claw back, but it's just been feeble. 20 points up from the lows. 10 points. Mitesh is now back with us with a few BTST calls for the weekend. Mitesh, 1% gone. Mid-caps 1.7.
I think the index, is heading into the gap level, but the weekly structure is slowly turning negative. So I would be, very cautious on taking long positions and be more attuned to take short positions till we get some sign of reversal on the Nifty, which would happen in case we start getting past 24,600. So till then, I think, not really keen to take long positions. On the stock side, I have a sell on Shriram Finance, estimated on Shriram Finance with a stop at about 615 for a target of 595. And the other one is REC, which is an STBT with a stop at about 383 for targets of 375.
Okay, all right, got that. Mitesh, thanks so much. Mitesh, actually, before we let you go and before we let you enjoy your freedom, your weekend, PG Electroplast, freedom and weekend actually. The company's conference call details are coming. They're saying that they did not anticipate such severe disruption in the first quarter in their AC business. Stock's been smashed 21%. What's the advice? Any levels on PG Electro?
You can look at levels, but I think the way this monthly chart is shaping up, this will be to corrective mode for quite some time to come by. One, I think on a pullback, if you get it, and typically sometimes you do get these kind of pullbacks like we have in IEX. But on a pullback, if you get it, my advice would be to lighten up, exit anything if you get close to about 640, 650 zones. And on the downside, if you look at the slightly longer term charts, good chance that we are looking at a target of around 465 to about 450 on the downside.
Got that. That would mean more than a 50% fall from its highs. By the way, from the PG Electroplast call, the company is also saying they've cut down their capex guidance. So earlier the company had planned 800 to 900 crore of capex for FY26. That's been lowered to 700 to 750 because the company is left with a lot of inventory and that has impacted the company's cash flow. So it's not just the guidance cut on revenue and margins. The company is also cut their capex plans. But let's talk about Kalyan Jewellers. That took a hit post Q1. Mangalam joins in for more.
Well, Kalyan Jewellers, it's a curious case because the results were not bad at all. 31% revenue growth, nearly 50% profit growth, margins expanding as well. The street would like that. The same-store sales growth of the company coming in at 18%, higher share of revenue coming in from the non-South businesses, and all the factors where the company has been speaking about growth actually playing out. And this despite higher share of revenues coming in from franchise businesses and gross margins coming in lower, the operating leverage has had their margins improve as well. But thereafter, we did see the stock decline. And this is not the first time. From its earlier peak as well, there was a sharp fall that we saw on the stock. And every time there were concerns, or chatter around what the management is doing with the capital, etc., management has come out clean and saying that they are not investing in any non-core businesses or anything which may impact the capital prudence of the company. This time around as well, none of the analysts in their published notes have mentioned any red flag. But then again, the curious case for Kalyan Jewellers continues. From the lows, the stock has already seen a bit of a rally, but from the highs, it had seen a big gash. And now again, after the rally, good numbers, the stock sells off.
Thanks a lot for that, Mangalam. That stock under some pressure. Cummins India, though, that delivered a beat across parameters. The stock is still holding in the green. Vamakshi joins us to run us through the fine print. Vama?
Well, Nigel, a good set coming in from Cummins India. This time around the revenues growth was almost at 26%, and this is largely being driven by good growth in both the domestic as well as the export market. The domestic market saw an uptick of almost 25%, and the exports saw an uptick of almost 34%. The margins also improved by 117 basis points to 21.45%, which is the highest level we've seen since Q4 of FY24. And the net profit too this time around was at a record high, growing by almost 40% on a year-on-year basis. Now, a conference call was held at 12 p.m. Today, and what the management has said is that they remain cautiously optimistic. They're expecting double-digit growth in FY26. They do not see any risk of cannibalization of sales from their new launch, which is the battery energy storage systems, that is BESS. They also highlight that the volumes are now back to the pre-CBCP4 plus level, and the pricing more or less has settled now, given that it's been a year since since the new emission norms came into force. But they have highlighted that there is still a lot of competition across nodes. They continue to work, however, on cost optimization measures. As far as exports are concerned, they highlight that due to a diversified portfolio, the share of exports to the US is not very high. In the last quarter, in fact, they highlight that LATAM, Europe, Africa, Middle East, all of these markets saw good growth coming in, and geopolitical situation is currently changing. That is the reason why they're cautious on exports. But however, they do say that they endeavor to maintain the gross margins at the same level. So a good commentary coming in from the management, some caution on the exports, and a good set of numbers from the company resulting in an uptick in Cummins India.
Okay, all right, got that. Thanks very much for the details there, Vamakshi. By the way, I think we'll just put out a story that our colleague Tim C is getting from New Delhi. Yeah, this is important. I mean, it's a pretty big deal. The Income Tax Bill 2025 is all set to replace the Income Tax Act of 1961, the latest version of the bill, the 2025 bill. That is going to be introduced, I think, on Monday, August 11. And the previous version is going to be repealed. So it's just procedural, but it's a big thing. The Income Tax Act of 1961, as we've known it for well over 50 decades, that makes way for the new income tax. It will be called then the Income Tax Act of 2025. Well, we'll take a break on that note. As we do that, do remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Okay, welcome back. So that's how the board is stacking up today. It's a whole shade of red, a sea of red, so to speak. Not too many sectors managing green. One of the stocks that's fallen today is Biocon. It's been down 5%. Clearly, the numbers, the investor call, not been enough to spark any enthusiasm among investors. Let's actually listen in to what the management has been saying.
Well, yes, for Biocon this time, the numbers did miss estimates. The revenue as well as the margins and profit was lower than what the consensus was expecting. Now, in terms of a couple of key takeaways, however, from the management included that the generics business, which grew around 5 to 6% this quarter, was in line with expectations in terms of growth. The generics business, however, they do expect will grow in double digits for the entire year. CRDMO segment continues to benefit from demand according to them. Now, the consolidated gross debt stands at around $1.1 billion, and they are expecting the interest costs to gradually reduce. Insulin Aspart, which is basically the diabetes biosimilar in their portfolio, the launch will be now and between the end of the year. Now, they are also likely to launch the diabetes drug liraglutide in the US this fiscal, and according to them, it will probably be the biggest growth driver for Europe going forward. Now, lastly, semaglutide, the market will open in 2026 according to them, and according to Biocon, the best case for them to probably launch or get approval for semaglutide will in the Canadian market, which is one of the lucrative markets that the street is looking at, would probably be towards the second half of 2026.
Thank you very much for that. Coforge is another stock which is weak in trade, and this is because one of their key clients, Sabre. Remember, Coforge had won a large $1.6 billion deal from Sabre. Well, Sabre came out with their numbers yesterday, Q2. It was disappointing. The stock tanked 35%. They've cut their revenue. They've cut the EBITDA margin guidance, and quite sharply. And this is why Coforge today is seeing that second order impact, because one of its key clients, perhaps even the top client, is come out with a guidance cut. Birlasoft is the other one. Again, muted set of numbers. In fact, the company said they may not even grow in FY26 in the conference call. So Birlasoft has also taken it on the chin today. But lots of other, losers. You've got Vishal Mega Mart. Despite making it in the MSCI, you are seeing a cut on that. Godrej Consumer is another stock. Street is disappointed with the margin performance. Stock is weak in trade. A lot of defense stocks like Bharat Dynamics lower in trade. Kalyan Jewellers, by the end of it, it's 10% plus. And by the way, on the Nifty, the sensex, the headline is 80,000 level is gone. That's the headline on the sensex front.
Absolutely. The sensex has indeed lost 80,000. Down 800 points today, the grand old index. Tough week for the market. 245 points gone on the Nifty, and not too many winners to count. Across the board selling, banks, financials, IT, nothing really has been spared. Just little specks of green here and there. NTPC, Titan, Dr. Reddy's, count in these 3-4 stocks. But beyond that, it has been a tough Friday.
Okay, well, with that, we're going to take your leave on Closing Bell. Don't go anywhere. Editor's Roundtable comes up next.